Welcome back to Investing Talk Podcast.
Today we're looking at Metsera, MTSR. The big question everyone is asking is it a good time to buy now amidst this massive acquisition frenzy?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For you, the investor watching Metsera right now, there's really only one story that matters in the short term, and that is the intense, almost theatrical bidding war driving the valuation.
And when we say intense, we mean it. This isn't some friendly merger talk. It feels more like a heavyweight fight. We saw the stock absolutely surge recently, right? Hitting a new 52-week high, $63.36, purely on the back of this aggressive interest from two major pharma giants. So what's the latest? Where are the battle lines drawn in this drama?
Yeah, it's a textbook merger fight, Alex, playing out not just in boardrooms, but now in courtrooms too. We know Novo Nordisk, they're the current leader in the metabolic health space. Obviously, they put a formal proposal on the table, valuing Metsera at $9.1 billion.
And Metsera's board jumped on that pretty quick.
They did. They deemed that proposal superior.
Okay, that designation superior, that's specific M&A language, isn't it? It means it's materially better than whatever else was there.
Exactly. It carries legal weight. But the other contender, Pfizer, well, they're clearly not going quietly into the night.
No kidding. What are they doing?
Well, Pfizer is still technically negotiating, trying to match or maybe even counter the offer. But more critically, they've escalated things. They've actually filed legal action.
Really? Legal action? To do what?
They're actively trying to block Metsera's ability to negotiate with Novo Nordisk, essentially trying to protect their own initial merger agreement. This legal move, it probably centers on something like a matching rights clause or maybe a hefty breakup fee provision. It just shows how badly they want this asset.
Right, they're pulling out all the stops.
They are, using every corporate lever they have to try and maintain exclusivity.
Okay, and this is where the speculation really kicks in, right? And why the stock's been so volatile. We know the $9.1 billion Novo bid is public, but there were those unconfirmed rumors. That Pfizer's initial offer was closer to $70 per share.
That's the rumor, yeah. Significantly higher than where it's trading even now.
So if that's even close to true, it tells you the market is pricing in a huge merger premium. It's expecting one of these companies to blink and go even higher, maybe above that $7 mark, to lock it down.
Precisely. And the legal fight just adds fuel to that speculative fire.
Yeah.
A long bidding war could definitely cause more short-term spikes,
Yeah.
But the major market-moving event we're all watching for is the formalization and closure of a deal.
When do we think that might happen?
Based on the filings and what we're hearing, that major event seems pretty imminent, likely within the next, say, 0 to 3 months. So right now, if you're buying Metsera, you need to understand you're placing a calculated bet on that M&A certainty, not really on their current operations.
Okay, good point. So that brings us to the core question. It's easy to get caught up in the bidding war drama, but let's ground this massive valuation, $9.1 billion for a company with no revenue yet, in reality. What exactly are Pfizer and Novo Nordisk fighting over? What makes this pipeline worth that kind of money?
It's the sheer size of the potential prize. Metsera is targeting obesity and metabolic disorders. And this isn't just, a big market. It's potentially a multi-hundred-billion-dollar therapeutic area. Right now, it's dominated by those GLP-1 drugs like Ozempic and Wegovy.
So the giants want in because Metsera might have the next big thing.
Exactly. They think Metsera has genuinely next-generation assets.
And specifically, they're after Metsera's lead drugs, these advanced peptide drugs. MT097I is the one we hear about most. Can you quickly break down why next-generation peptide drug is such a buzzword right now?
Absolutely. So think about the current anti-obesity drugs, the GLP-1s. They work, sure, but they have side effects. Some people plateau. A peptide drug is basically a short chain of amino acids designed to mimic or block a natural hormone. The next generation part suggests maybe better results, maybe fewer side effects, or, and this is key, maybe achieving significant weight loss faster, or with less frequent dosing, or working well in combination therapies. These companies are essentially hunting for the Wegovy killer, or at least something that can seriously compete.
And the specific data point that seems to have lit the fuse under this whole thing, that comes from their phase 2B results for MET097I, right? That's the nugget driving this valuation.
Is the absolute core. That phase 2B trial showed really breakthrough results. Patients achieved up to 14.1% placebo-subtracted weight loss.
Yeah.
And get this, over just 28 weeks.
28 weeks? That sounds fast.
It's incredibly fast.
Yeah.
To give you some context, The current market leaders, like Novo's best drug, they hit mid-teen percentage weight loss, but that was after about 68 weeks.
Wow. Okay.
So achieving 14.1% in less than half that time, that's stunning. That speed and the amount of weight loss strongly suggest a real therapeutic advance, and that is what's justifying the investor optimism and, frankly, the institutional rush to get in.
Yeah, and the big money definitely seems to agree. It's fascinating that the institutional buyers are confirming this potential. We saw major players adding to their positions in Q1 2025, like T. Rowe Price, a huge fund manager, and even Alphabet.
Yeah, that Alphabet involvement is particularly interesting, isn't it? It signals something deeper. It's not just another biotech bet. It feels like confirmation that major diversified capital sees metabolic health as a central pillar for future health tech and investment.
So when the institutions pile in like that,
It's usually a strong sign that the market believes in the clinical potential, almost regardless of the current financials.
okay, fair point. But we have to look at those financials. We can't just focus on the shiny phase 2 data and the big bidders. We need to look at the cold, hard reality. So if they're potentially worth $9.1 billion, what's the actual state of the company under the hood? What are the risks here for an investor buying into a company with, well, zero revenue?
And this is where we definitely need to pump the brakes and check the gauges. The risk is significant, which, to be fair, is pretty standard for a clinical stage biotech.
Right.
Since Metsera is pre-commercial, their revenue for the trailing 12 months is literally listed as nah. Nothing coming in from product sales yet. And that means they're burning through cash with heavy losses funded entirely by investment capital.
Okay, how heavy are those losses? Give us the numbers.
We're looking at a net loss of about $308 million over the last 12 months. The latest quarterly net loss was around $69 million. And this is driven largely by their R&D spending, which is high, about $60 million just last quarter.
Wow. Okay, but the R&D spend is necessary, right? That's the double-edged sword. They
Yeah.
have to spend that money to push drugs like MET-097I through phase 3 trials and get them approved.
Absolutely. It's the engine of their potential future value. But yes, it consumes immense amounts of capital. It's the cost of playing in this high-stakes game.
Which means a high cash burn rate.
Exactly.
Yeah.
But, and this is the crucial mitigating factor, the thing that maybe separates Metsera from some smaller biotechs facing cash crunches, they have liquidity. The company actually has a very healthy cash position right now, $531 million.
$531 million. Okay, that is a substantial cushion. So, based on their current spending rate, how long does that last them? Assuming, worst case, the acquisition falls apart completely.
It gives them a pretty decent runway. That $531 million is enough to fund several quarters of development, easily stretching past a year, probably more, even with that high burn rate. Plus, their total liabilities, around $190 million, are quite manageable and completely covered by the cash they have.
So while the income statement looks rough, deep in the red.
Right. But the crucial thing for you as an investor is that the immediate existential risk, the risk of them just running out of money tomorrow, that seems largely off the table for now.
Okay, that's reassuring. So liquidity risk is somewhat mitigated. Let's shift back to the markets, Stu. We've seen this huge run-up, hitting over $63. Is the strong buy consensus we hear about still valid, or has all this acquisition talk pushed the stock into maybe dangerous territory?
Well, technically, the momentum is still bullish. You look at the charts, the stock is trading way above its 50-day and 200-day moving averages. And the volume surged on the news, suggesting real institutional buying, not just retail hype.
But I sense a but coming.
But the valuation story,
Yeah.
yeah, that's where the warning signs are flashing bright red.
Okay, so what are the analysts saying specifically, and what's the key metric investors should be wary of right now?
Analyst consensus does generally remain strong buy, mostly based on that pipeline value we talked about. However, look at their actual price targets. They range from about $55.25 up to maybe $58.50.
And the stock is trading above that range currently.
Exactly. It's trading above the highest analyst target, driven almost entirely by this M&A speculation. And the single number that really jumps out, the one that makes you pause, is the price-to-book ratio. It's currently sitting at 12.26.
12.26. Wow. For any company, that's high. For a pre-revenue biotech, that sounds stratospheric. Can you break down what that specific number means for someone thinking of investing right now?
It's absolutely crucial context. Price-to-book compares the market value to the company's net assets on paper, basically, what it might be worth if they sold everything off and pay their debts. A PB of over 12 means you, the investor, are paying more than 12 times that liquidation value.
So you're not buying tangible assets or current earnings.
Not at all. You are purely buying the hope of future drug revenue, and Even more specifically, right now, you're buying the belief that a big pharma company will pay a massive premium to take on the risk of developing those drugs. The valuation is almost entirely based on future expectations and that merger premium, not on current intrinsic value.
Which just hammers home the point. Any investment here today is a high-stakes, event-driven bet. It brings us back to risk. Beyond the obvious valuation concerns and the ever-present risk that a phase 3 trial could fail down the line, what's the immediate risk someone takes on if they buy in today?
It's the uncertainty swirling around that Pfizer litigation. It really complicates the deal closing. If Pfizer's legal action somehow succeeds in delaying or preventing Metsera from finalizing the deal with Novo Nordisk.
Or if both companies just get fed up with the legal battle and walk away.
Right. If either of those happens, the stock price is likely to suffer a very steep, very immediate pullback from these highs. The litigation acts as a volatility multiplier. The downside risk is real, it's immediate, and it's tied to a legal outcome that's incredibly difficult for most investors to predict.
Okay, so if you're an investor sitting on the sidelines, maybe trying to decide whether to jump in, what specific events should you be laser focused on over the next, say, 3 months?
The upcoming events are clustered and they're critical. The undisputed #1 catalyst is, of course, the acquisition or merger closure itself. That decision will determine the final premium, assuming there is one.
That's the big one. What else?
Second, pay very close attention to the earnings report. It's expected around mid to late November, maybe the 15th to the 26th. Now, obviously, the revenue line will still be zero, but management will provide updates on strategic progress, clinical trial timelines, and crucially, commentary on how the acquisition process is going. You'll want to parse their language very carefully there.
Good tip. Any smaller, maybe technical factors to keep an eye on towards year end?
There is the potential for some technical volatility from ETF index rebalancing. That usually happens towards the end of November, maybe around the 29th. If Metsera gets added or its weighting changes in major biotech indices, that could create some temporary buying or selling pressure, adding a bit of noise.
But really, it all comes back to the deal.
Absolutely. All eyes are on the M&A outcome.
Okay, so summarizing the investment thesis here. Metsera looks attractive primarily because its pipeline, especially MET097I, shows genuinely exciting, potentially breakthrough data in a massive critical market. That's confirmed by the big money, the institutional interest. So the investment proposition seems kind of dual. It could work for a short-term, event-driven play trying to capture that merger premium.
Right, if you're comfortable with that risk.
But it also offers potential long-term exposure to this huge obesity drug wave if you can stomach the wild ride in the clinical risks.
Yeah, that's a good summary. But let's be clear. Right now, you are absolutely buying into event-driven drama, not necessarily a discounted fundamental asset. Although Metsera has a pipeline that could genuinely change metabolic medicine, the immediate upside or downside hinges almost entirely on whether Pfizer or Novo Nordisk seals the deal and at what price. If you buy in now, you're making a high-stakes speculative bet on the outcome of a corporate and legal battle. If you can't tolerate the risk of a major drop if the deal fails, maybe wait for more clarity.